this conference. A PhD student and teaching assistant at the Department of Banking and Financial Market at the University of Warsaw. He holds an MA in Econometrics and IT from the Faculty of Economic Science, University of Warsaw. He was a one-year visiting PhD student at the University of Groningen. He's a member of the Post-Keynesian Economic Society. He won the first award in the 10th edition of the President of National Bank of Poland competition for the best master thesis in economic science, defended in 2016. His research interests lie primarily in the area of monetary policy and the post-Keynesian theory of monetary macroeconomics. In particular, his research focused on the quantitative easing policy, debt management, and the modern monetary theory. Gracian.
Okay, thank you, Marcin, for your kind introduction. And so welcome, everyone. So I'm delighted to be chairing the session on Kalecki and the fiscal deficit and debt management. So please remember to remain muted. You will be able to ask questions after the talk by raising hand. This option is available in the participants box or by writing directly in the chat box. So the session is 90 minutes long, and now let me introduce our guest, Jan Toporowski, who will have 45 minutes to speak. So Jan Toporowski is a professor of economics and finance at the SOAS University of London. He was a visiting professor of economics at the University of Bergamo and a professor of economics and finance at the International University College in Turin. He studied economics at Birkbeck College, University of London, and at the University of Birmingham. He has worked in fund management, international banking, economic consultancy, and central banking. He has published widely on money, finance, and economic development, but also on monetary policy and the history of economic thought. And he is the author of a widely praised two-volume biography of Michał Kalecki. So please welcome Professor Jan Toporowski. The floor is yours.
Okay, well, thank you very much for that generous introduction. I'm very pleased to be in this august company. In particular, many people here who knew Kalecki. At least one person here who knew Kalecki, and but I think a lot of people who I think are outstanding economists in their own right. I never actually met Kalecki. Jeff Harcourt used to be very kind in writing references for me, and he would say, "You have to have Jan Toporowski. He met Kalecki," which actually wasn't true. And I don't know where he got the story from, because I never said this. Instead, I met Jerzy Osiatyński and Krystyna Markutso, Kazimierz Łaski, many other people who were very important. I also, incidentally, met Edward Lipiński, who was, I met him once, and I guess one of the things that always stuck in my mind, apart from him as a personality, Lipiński did have a very strong personality, but I always remember a remark he apparently once said of Tadeusz Kowalik. Tadeusz Kowalik was another important figure in Polish economics, collaborator with Kalecki in his final years. Lipinski once said of Kowalik that Kowalik was someone who could write beautifully. His prose is beautiful, and for those, it's maybe difficult for those who are not Polish people to understand. But he had Tadeusz Kowalik had a very fine way of expressing himself. And I do recall in one piece that he wrote about Lipinski after Lipinski had died, and Tadeusz Kowalik owed a lot to Lipinski because when Tadeusz was banned from publication, he published one or two pieces under Lipinski's name. Lipinski allowed him to use his name. Anyway, in return, Tadeusz Kowalik wrote a very fine memoir of Edward Lipinski, which contains the following remark. He talked about Lipinski's early years, his studies. Lipinski came from a generation that left Poland to study abroad, and he came back to Poland sometime during the First World War, and went to work as an economist. Eventually got fed up with it, and the phrase that Tadeusz Kowalik used, which was very, very nice, was that Lipinski was exhausted by incessant calculations at the bank, and as a result, he left the bank to go and become an academic. And I rather like this phrase of being exhausted by incessant calculations. This strikes me being a very nice definition of mainstream economics. But let me get on to Kalecki and his, right, here we are. Here we are, I've got my slides. Yeah, oops. There we are. Let me start off with a few remarks about this and the origin of this. What I've, when I was in the process of writing my biography of Kalecki, I came across quite a few remarks that Kalecki made about monetary theory, monetary policy, and they were all, there were some of them, I think Malcolm mentioned earlier on. And they were just fragments, and they tended to be fragments which Kalecki would express in a particular article to show how a particular policy was feasible. And then he would drop those, drop that when the paper came out in a different form. So, for example, the famous paper on political aspects of full employment. In that, Kalecki made in the first version of this, in the one that was published, he included an explanation of how full employment could be financed. And then when he republished this already in his lifetime, he dropped the financing part and the monetary part. So, and obviously he thought this was less important, because as he made clear throughout his life, what Kalecki was most interested in was the theory of the business cycle. Why is it that capitalism is unstable and cannot sustain any kind of equilibrium? And what I did after I completed the biography, I got all those fragments together. I've put them together. They're going to appear in a book which I've more or less finished now. And what's interesting about this is that if you put all those fragments together, they're remarkably consistent. They are a consistent view of how money works, how money circulates, and a consistent view of the financial system. And in particular, there were much of this was material which he wrote during the Second World War, when, yes, wartime policy was important. The question of full employment and its macroeconomics was important. But first and foremost, in determining its viability and the war effort was the financial question. How can you do this? How can we afford this? So putting those fragments together, they come out in a nice, consistent whole, and actually is very consistent with two elements of his work, which I will come back to later on. One is his theory of profits, and the other one is his early work on national income and expenditure. As some of you will know, Kalecki was a pioneer in developing national income accounts. He made them up for Poland in 1929, 1930. And what was interesting about them was that they were not just done by the standard categories that we know from the national income accounts that we use in macroeconomics, not just those standard categories, but that they also divided up income and expenditure by social class, and that I think is important for now, and in particular, as I shall show, for the for some of the problems with government debt, which he later tackled. Okay, so let me. Oh, by the way, I should also add that much of this work comes from my consultancy work, work that I've done for UNCTAD and the UN Conference on Trade and Development and the UN Economic Commission on Africa on sustainable debt. And as I will argue, I'm really showing how you make debt sustainable, how Kalecki argued that debt can become sustainable. So let me say, by way of introduction, I mean, that was just a general chatty introduction. More formal introduction. Kalecki, as Malcolm told us earlier on, Kalecki argued for a permanent regime of fiscal deficit. He argued that this was vital. At one point, he was arguing this from the point of view of the balance between saving and investment. But if you look in greater detail, it wasn't just that there was that saving exceeded investment, but it was a specific issue of household saving, something that Steindl was later to pick up on. Because if you have excessive household saving, then you have, as a result, excessive deficit in the business sector, among businesses, and this is you have financial deficit there, and this causes this has consequences for investment and the way in which national income or national income dynamics, investment, and so on. Okay, if you have a permanent regime of fiscal deficit, then the resulting public debt has to be managed in order to ensure that there is adequate liquidity in the financial system. And what was interesting about the way in which Kalecki argued this is that he showed how this regulation of liquidity in the financial system should be done by using fiscal as well as monetary policy. Fiscal policy in the sense of debt management, as well, rather than just monetary policy, liquidity, financial liquidity, strictly as a function of the supply of money from the central bank. So debt management is a part of monetary policy, and this is a kind of an intriguing aspect of Kalecki. In this respect, he was very close to Keynes. The last mainstream economist who argued for this was none other than James Tobin, and it's intriguing that this aspect of regulating the financial system is totally dropped out of the economic discussion. And then it's by a third point is that the principles derived from Kalecki's early work on national income expenditure have important relevance. They have important relevance because he really showed how Kalecki, how fiscal policy and debt management can be used to regulate, as I say, this liquidity. And in particular, now in the world of COVID, one of the reasons why I came to this analysis, which I'm going to present today, is because I had been doing some earlier work on the financing of COVID, and I think this is what I'm presenting now. I think is useful for that. Okay, what I argue here is that the government budget, what one should do with the government budget is to split it into two parts. One part which we can call the functional budget, which consists of all the expenditure, all government expenditure in the real economy. In other words, government expenditure on public services, on welfare and transfer payments, and various subsidies. And on the revenue side, all taxes on incomes and expenditure in the economy. These are the taxes that affect expenditure in the real economy. So, for example, payroll taxes, sales taxes, those kinds of taxes. Why? Because those are the ones that affect expenditure. If we want to be more up to date, let's say taxes on pollution, carbon levies, and so on. Why? Because these are designed to alter incomes and expenditures in the real economy. Incidentally, also, by the way, tariffs on trade. Now, what I'm arguing it for in this paper is that you have a separate budget which contains on the expenditure side is the servicing of government debt, and on the revenue side, taxes on property, in other words, wealth taxes, inheritance taxes, and capital gains tax, plus taxes on profits that with an allowance for investment to maintain the pre-tax profitability of any given investment. So, as you can see on the what you have on the revenue side, on the financial budget, are essentially the taxes on capitalists, and on the expenditure side, as I say, is the servicing of government debt. We include here also the taxes on property, of course, includes the famous capital levy, which Keynes had argued for in the Second World War, and Kalecki as well, and which Kalecki famously argued for, illustrating how these kinds of taxes don't affect expenditure, because he said if you have a tax on wealth, it doesn't matter, doesn't make a difference whether a businessman who has to pay this tax takes his liquid assets and uses them for investment purposes, because he'll buy an asset whose value is the same as the money that he spent on that asset. So his wealth hasn't changed. And therefore, Kalecki's argument was that this is, those are the kinds of taxes which do not affect expenditure in the real economy. Now, what comes from this are certain principles of fiscal policy. First of all, functional budget. In an earlier draft of this paper, I called it the primary balance, but this is perhaps incorrect, because the primary balance is usually the term that refers to the fiscal balance, excluding payments, the servicing of government debt. Whereas what I mean by the functional budget is that part of the budget which influences aggregate demand, and it doesn't include all taxes. So your functional budget influences aggregate demand or expenditure in the economy, either because it's a tax on expenditure or it's a tax on particular income, which will make a particular kind of expenditure undesirable. The financial budget influences the liquidity of capitalists, and I will explain this in the next slide. Now, what's intriguing about this is that this kind of a split budget gives you two more or less independent fiscal instruments: a financial budget for debt management, and secondly, a functional budget for aggregate demand management. And I think that this is very important, because I think this gets around, I mean, it satisfies the Tinbergen rule. You've got two independent instruments, but it overcomes the fundamental problem of fiscal policy in political economy, namely that fiscal policy is split between fiscal conservatives, who believe that the purpose of the fiscal balance should be to pay off the national debt, pay off government debt, so that this terrible burden is lifted off our children, because that is the way in which they visualize it. And then as opposed by the Keynesian camp, and the Keynesian camp has always argued that actually the fiscal deficit doesn't really matter because if you have a sufficient fiscal stimulus, you will get economic growth, and out of the economic growth, the economic growth will generate sufficient growth to pay off the national debt. Now, my view is that both positions are wrong, because in the end, you have to understand the relationship between fiscal policy. You have to have a more specific, you have to analyze a more specific relationship between fiscal policy and economic growth. And secondly, I don't think that you should, you can argue that the growth will be sufficient. You have to show how this will come about, but you also cannot ignore the financing of the deficit. Now, how you're going to you cannot ignore the question of how you're going to maintain the system stable through your fiscal stimulus. Okay. The third point, the fourth point of this principle, and this also applies, as I say, to this old controversy between fiscal conservatives and Keynesians, is the importance of domestic financing. Kalecki was absolutely clear that, and I think Keynes, by implication, was clear about this, that if you're financing something like a war effort, or you're financing the COVID, your medical measures over COVID, you have to have you need to do this preferably domestically and not through foreign financing. What is the difference? Well, the difference is that if you finance, let's say, economic development, or COVID, or a war through foreign financing, then effectively it is a burden on future generations, because future debt payments are taken out of the economy. If you finance domestically, then this doesn't arise. If you finance domestically, all you're doing is you're making transfers within the economy. You're taxing taxpayers and paying the money to government bondholders within the economy. And this was Kalecki's insight, rather clever insight, that if you tax those bondholders, you can actually tax those bondholders and use their money to pay off the debt, or to make the payments on the bonds that the wealthy hold. He explained this in 3 ways to full employment, and actually Keynes wrote to Kalecki to congratulate him on this particular insight. Let me now move on to the question of the dynamic implications. How does this kind of analysis, how does this kind of split balance, a split budget approach influence the workings of the fiscal multiplier? Well, let's. What I've done is you've got a table there in front of you showing showing the balance in the functional budget. This is the one that affects the real economy. The balance in the financial budget, the overall balance, the ex ante overall balance, and finally, what would be the macroeconomic outcome of this. So I'll start off with the top line. Let's take a situation where the functional budget is in deficit. In other words, the taxes on the real economy and tax revenue is lower than the amount of money that the government is spending in the real economy. And this is financed to a great extent, this is completely financed by a surplus in the financial budget. In other words, the capitalists are being taxed for this. You have a progressive tax system which is taxing wealth, and that taxation is in excess of the amount of money that is being paid to the wealthy who hold government bonds. And so the overall result can be a balanced budget, or if you're really oppressing the capitalist class with taxes, it can even be a surplus. The overall budget balance can be a surplus. The macroeconomic outcome in this situation is actually an expansionary fiscal contraction. Why? Because you've got a balanced budget, possibly a surplus in the budget, but because you are taxing the wealthy much more heavily than you need to for the purposes of debt management, and you're using their surplus taxes to spend in the real economy, you're effectively redistributing income from the wealthy to wage earners, if you like, or from rentiers to business, to entrepreneurs. And this would tend to have an expansionary effect. So this is this expansionary fiscal contraction that featured in some of the discussion on a fiscal multiplier a couple of years ago. If you, I contrast this with what I think, and this I think is a very rare case. What is much, I think, more common is the tendency to create a surplus in the functional budget, particularly in recent years with fiscal policy orientated towards higher indirect taxes, raising of VAT, and reducing taxes on wealth, reducing taxes on profits on the grounds that on the grounds that you need to treat the wealthy nicely, because otherwise they will, as Malcolm told us, well, Malcolm relayed the account of Kalecki's, the capitalists will lose confidence and stop investing. So you tax them lightly, but you do this, you pay for this by running a surplus in the functional budget. And then what you get is this, you may end up with an overall deficit, but because the functional budget is in surplus, the tendency is to is for the economy to contract, or for growth to be slow. You have a problem of economic stagnation. So this is this, I think, is what characterizes a lot of the fiscal stance of recent years, certainly in the US and in the UK, perhaps less so in Europe. A third possible outcome is one where the functional budget is in deficit. The fiscal balance, the financial balance is also in deficit. And the result is that you have a fairly large overall budget deficit. This is, quite clearly a characteristic feature of weak states, or states that are unwilling to tax wealthy people. And what you have then is a kind of expansionary financial instability. It's expansionary because of the deficit on the functional budget, but there's instability because the deficit in the financial budget and the deficit in the functional budget is giving rise to an accumulation of liquidity in the corporate sector and in the banking system. Let me be clear. Kalecki's view, because this was something which perhaps didn't come out of Malcolm's presentation. Kalecki's view was that if you paid workers more, if you redistributed income from capitalists to workers, the capitalists would get the money anyway. And why is this? Well, because workers, on the whole, don't save very much on balance. So they spend the money, and in spending the money goes back to the capitalists. So the more you redistribute towards workers, eventually the money is going to go back into the accounts, and not just of business in general, but specifically the dominant monopolists who control the economy. And finally, and this is the what I call in the paper the mecca of fiscal conservatives. This is a situation where the functional budget is in surplus and the financial budget is also in surplus, as you may or may not be in surplus, but you've got an overall surplus, and this is what I would call deflationary financial instability. It's deflationary because money is in effect being transferred from the real economy, from what Keynes called industrial circulation, into financial circulation. The financial system is becoming more and more liquid. Why? Because what does the government do with a surplus? It can do one of two things. It can either pay off the national debt, or, as Malcolm pointed out, it can use it to buy assets. But if it buys assets, who does it buy them from? It buys them from capitalists. So capitalists become more and more liquid. Something which I could never understand when I was reading about Ricardo's, all these 19th century plans to pay off the national debt. Did no one think about the consequences of dumping this huge amount of money on the into the financial system, and in effect monetizing the national debt? But it does cause financial instability, and the key financial instability for most countries, it's different in the United States, but for most countries, is that as the system becomes more liquid and more unstable, the alarm goes up about inflation, and then there's a tendency to get out of the currency and into a currency which is believed to be more stable, have more stable value, and then you have, if you have a run on the currency depreciates. That's when you get the inflation. Okay, I'm finishing shortly. Right. I mean, this paper is really just the start of a study which I hope will lead towards what I hope is a more comprehensive public finance reporting, a government budget that sums overall to zero. Why? Because you would include in it not just the surplus or the deficit on revenue and expenditure, but you would also show how this is affecting how this is being financed, and how this is affecting the financial system, so that you're showing that financing, and in this way getting away from all these stories about burdens on our children, this, that, and the other. Let's be specific about the financial structures, the debt structures that we're looking at. As I said, there is a use of monetary of the overall surplus. This needs to be spelled out. If fiscal conservatives want to argue that they want that the government should have a surplus, they should explain what this surplus is going to be used for, and how this will affect the financial system, and how the liquidity in private sector wealth portfolios would be managed. I think this is in this respect, I think Keynes went that little bit further than Kalecki went that little bit further in his analysis of liquidity preference than Keynes did. So I'll leave it there, and let's have a discussion. Thank you.
Thank you very much, Professor Toporowski. And now I open the floor for the questions. So please raise your hands. Okay, we have first question from Ilan Dogus. So Ilan, please unmute yourself and ask question.
Yeah. Hi, Jan. Happy
Hi.
to see you. Thanks for presentation. I think first such a policy constellation can help to definancialize the economy by inducing capitalists to make profit from real investment rather than financial transactions through such an taxation. And but my question is that on the day you sent us this paper draft, there was a letter of billionaires in which they call Texas. They ask for more taxing from the governments to fund the. And this reminds me of the question: if it is a capitalist state, why don't they listen these capitalists? In a capitalist states, as argued by Marxists, the state is subordinated to capitalist class. Are they more royalist than the king, or how can we explain this resistance to not tax them despite they call for taxing more? Thanks.
Okay. Yes, that's a very nice question. I think I will pass on your comment. Literally pass in the sense that I won't comment further on your comment on definancialization. I actually think some financialization is useful, and in fact, Kalecki showed how some financial transactions are useful to regulate the liquidity of in the financial markets. Higher taxes for capitalists. I think what's interesting about those capitalists who asked, those billionaires who asked for higher taxes is that they are the corporate capitalists. They are the people who are, who run the big corporations. Now, the vast majority of capitalists in any country are small businessmen, small and medium-sized, or running small and medium-sized enterprises. They don't want higher taxes, and with some justice, because they are their lives are pretty precarious, and they're made more precarious by the kind of deflationary corporate financial policies of the big corporations. The American the top American corporations that are sitting on, I don't know, $5 trillion or some vast amount of money, rather than investing it, and not realizing that the counterpart of this is the indebtedness of small businessmen. And I think that this is a serious problem. But yes, I believe genuinely in the liberal instincts of the wealthy. I think it is genuine, and the reason why it's genuine is that the is a remark which Marx made about the money capitalists, where Marx said that the money capitalist does not look into the face of the exploited worker. He doesn't see the sweat on the brow of the exploited worker, something like this. And I think this is true of Warren Buffett. It's true of Gates and these other people. They are they're wealthy people. For them, running their business is a game, and I think they don't realize that they are actually part of the problem. But then even if they knew that they were part of the problem, what could they do about it? It's the system.
Okay, so if that's we have another question from Eckhart Hein. So please unmute yourself, Eckhart, and ask your question.
Hi, Eckhart.
Hi, John. Thank you very much for this presentation. I have one question, which also bothered me when I prepared my presentation, and also it was also contained in Malcolm's presentation. Now, why is Kalecki and then you following his arguments discussing taxes or taxing the capitalists in order to cover interest payments on government debt? I mean, taxing the capitalists in order to improve income distribution, that's what I would understand. But why does he consider it to be necessary, question mark, to pay for the interest on government debt? Because if you, well, Malcolm has presented it, I have presented it as well, and it was, Dharma already had it. If you have a growing economy and the rate of interest is below your growth rate, then you don't need taxes in order to service your debt. So why is he discussing that? So it's something which I did not fully get, and I did not fully get in your presentation.
Okay, let me answer this because it's really a question that concerns this very the transfer, what I call the transfer theory of debt. The notion that when the government issues national issues debt, it issues bonds. The bonds are held by capitalists, and it's a transfer theory of debt because thereafter the payments on that debt are have to be made from taxes. Now, in Keynes's time, in Kalecki's time, government bondholders were the wealthy. If you run if you have a permanent regime of a fiscal deficit, the amount of government debt is constantly increasing. Kalecki was adamant that this should be financed through the issue of bonds, because you want to maintain financial stability. You don't want this money that the government spends to continue accumulating in the financial system because it becomes unstable. So that your the transfer from taxpayers to bondholders is affecting a regressive transfer if you have a system where the middle class and the lower class are being taxed to make debt payments for the upper class, so to the upper classes. So what you need to do, and this is as the national debt rises, is you need to make the tax system more and more progressive. And the ultimate kind of way of making it progressive is simply to put a tax on bondholders, a wealth tax on bondholders. So effectively, you make the bondholders pay the interest that they receive on government bonds, and in that situation, you can carry on indefinitely. Yes.
Grazian, will you allow me to assist to get something to the answer that Jan provided?
Yes.
I seem to remember that at the seminar on the third world countries, Kalecki argued that part of debt is of government debt is in the hands of non-residents, and you must not discriminate between residents and non-residents of government bond holders. And therefore, you need to service the debt. Otherwise, of course, the debt could be also, the cost of servicing of the debt could also be rolled over to next year and still to the future. But precisely because you need to service those government bonds that are in the hands of non-residents, you also need to service those that are in the hands of domestic bondholders. Sorry to interrupt you. Thank you.
Okay, thank you, Professor Szatiński. So, Eckhart, do you want to add something, or?
Yeah, I didn't buy the first step. I mean, I fully agree with what you're saying. I mean, about the progressiveness of redistribution if we have taxes on wealth. But why do you have to raise taxes in order to service your debt? You can issue new debt in order to service the stock of debt. And if you do so, and the rate of interest is below the rate of growth, your debt to GDP ratio remains constant or might even fall. So I don't get this. And this is something which was already known in the 40s and published by Domas. So I still am not fully convinced with your answer.
All right. I think we have to move forward because you have some other questions. And Louis-Philippe, I think you have a question.
Well, just on this discussion, what do you do then? The mainstream reply to your argument, Eckhart, is that the interest rate will not stay lower than the growth rate forever. So eventually, interest payments will increase. That's the traditional mainstream argument, which I don't agree with, but that's the argument.
But Kalecki argues that is where central banks come in and keep the interest rate low. I mean, that's what I presented 1.5 hours ago. So I still don't.
Yeah, no, and I agree with you. I wanted to see what, okay, listen, Jan, I had a question that was asked of Christina yesterday, and in listening to you and Malcolm and Eckhart, it came back to my mind because the MMT crowd, and I'm not an MMT by any means, but they do rely a lot on Lerner and functional finance. And the question that was, I think, posed to Maria Christina is, what is the relationship, or how do you bring Lerner into Kalecki, or how do you see the parallels between Kalecki and Lerner on functional finance?
I'm afraid I don't know Lerner's work sufficiently well. I think Kalecki, on the whole, was you know, would have gone along with functional finance, but he was I think what maybe what distinguished Kalecki from Lerner was that Kalecki was much more aware that government expenditure is has monetary consequences, in particular because you're throwing into circulation, the government is throwing money into circulation, which then through the process of exchange and production becomes concentrated in the accounts of big business and their banks, and this is something you need to regulate that liquidity. So yeah, Malcolm's just made a good point. Yes, I mean, Kalecki was thinking of an annual wealth tax, but I mean later on he. Keynes was also in favour of wealth taxes. Incidentally, I did, if you, let's say, take taxes on property as a kind of wealth tax, as the equivalent of a wealth tax, you look at the UK and you would see that because I looked at some figures for the UK economy, and you find that the taxes on property greatly exceed the government's expenditure on interest, and that the if you're if the interest is and this looks rather odd for a conservative country like Britain. When I looked at it more carefully, I realised that what they're talking about is in Britain a tax on residential property, which is in effect a tax on the middle classes, because there's a ceiling, there's a maximum ceiling that on this tax, and it means that the very wealthy, it's actually regressive at the higher higher levels of income. It's only mildly progressive at lower income. So it doesn't quite fit the bill. So these are some of the issues I think that arise.
Okay, so now Paul Zaremka, you can ask your question.
Hello, Jan. It's been quite a while since we've had occasion to be at the same conference at the same time, but it's very nice. My question is naive, I guess. Back to Kalecki, I guess your second slide refers to his permanent fiscal deficit.
Yeah.
And I'm wondering, he must have had a ceiling on that permanent deficit, I suppose. I'm wondering, the ceiling might be to get to full employment, could that ceiling be so high to get to full employment that it really, you can't sustain that high a level of deficit spending? In other words, it's one thing to say you need to have deficit spending, but it's another thing to say how far you are willing to go with that deficit spending. So that's the question.
But actually, Kalecki, on the one hand, used to argue about a deficit spending, but he was very, very sanguine about the possibilities of taxing the rich. So that, and my sense is that he was more concerned about the total amount of government expenditure in the economy. That was what was important for him. Issues of redistribution, issues of
in other words, so if you needed to have a very large stimulus, you raised taxes sufficiently, even if it left to a deficit spending, no problem. Is that what you're really saying?
No, that it was, yes, deficit spending was useful, but it could always be adjusted. It should be managed by taxes on the rich.
Okay, thank you.
Okay, so we have some other questions. So Amitava Dut, I think you have a question, so please unmute yourself.
Yes. Hi, Jan. How are you doing?
Hi, Amitava. Nice to see you.
Hi. Okay. Since there have been 3 papers on fiscal policy, I've kind of, it's all one big blog to me. So I might have missed something that was said, but I had 2 questions. One is the issue of corporate taxes versus taxes on capitalists who, in fact, make investment decisions to some extent. I'm leaving out rentiers, pure rentiers.
Yeah.
Does Kalecki have anything to say about how these two would affect investment differentially? The second question I have.
Which two? The
corporate taxes.
Yeah.
Versus tax on capitalist dividends, let us say. Okay. The other question is about the discussion of full employment, as if that is a obvious thing. Like before the COVID problems, Donald Trump said, look, I'm great because I've pushed unemployment as low as possible, including for the blacks. The question is, at that time, maybe it was not so important about having the informal or what is called the gig economy, right? Does that, I mean, it would be too much to expect Kalecki to have some views on that, or for that matter, Lerner, but what would be sort of the implication of this kind of change, was not just open unemployment, but also underemployment, or whatever you want to call it?
I'm in general on the on the question of full employment. Yes, Kalecki was always in favour of full employment. The question is, well, what is and what constitutes full employment, and then what are the problems that arise when you do get to full employment? And Kalecki made clear that they are you get a very specific form of political problems that emerge with full employment. You actually start having to do manage incomes much more explicitly with full employment if you want to regulate inflation. So they.
So sorry, Jan. I just want to clarify that I was questioning the relevance of the notion of full employment itself due to the existence of underemployment.
Yeah, I think that you're right to question that. I mean, I kind of, if I was going to summarize Kalecki's viewpoint, which is that in the case of equilibrium, and a capitalist economy is maybe in equilibrium at any one time, except for two markets: the market for capital and the market for labor. Those, by definition, are never going to be in equilibrium in a capitalist economy. And I think one can read Keynes and Kalecki as being explanations for why these won't be in equilibrium. I mean, the issue of the wages and prime costs that we were talking about. That whole argument is around the issue of why doesn't the labour market get into equilibrium in the way predicted by general equilibrium.
Okay, so we have
Hold on. The question of tax and dividends. I think Kalecki would have been quite happy on taxing dividends, but his view was that you had to be careful with corporation taxes to ensure that you maintain it didn't adversely affect the rate of profit on investment.
All right. So we have a question from Maria Cristina Malcuso. So please unmute yourself, Maria, and ask your question.
Oh, Jan.
Hi.
Hi. So in all this discussion, what I thought was perhaps a little bit missing is something for which I think Kalecki was very famous in a way. He was always aware of the political feasibility of any proposal that he made. I mean, he had a sense, perhaps even more than Keynes, whenever you put forward any policy prescription, whether this was politically feasible. Now, as you may know, Italy is hitting almost 160% of its debt ratio at the moment. And I'm wondering what would be politically, whether it would be politically feasible to have a tax levied on debt. Who would buy Italian debt? If there is even the faintest idea that there's going to be taxes on it. So I just wonder how this policy prescription, is it ever possible whenever the debt ratio is very high, as it is in Italy now?
Yeah, actually, Kalecki's argument was not that you impose a tax on government bonds or even on explicitly on government bondholders, but you impose a tax on wealth.
I thought you said I thought you said something about. That's why perhaps I misunderstood you. I thought you said a tax on bonds.
No. It's what I meant was a tax on the wealthy who would be holding bonds.
So is a wealth tax?
Yes, it's a wealth tax.
Yeah, but what happens if the bond holders are small bondholders? What happens? How do you discriminate? Just on the basis of the level of wealth?
On the basis of the level of wealth.
Yeah,
and this is why it won't make any difference. It won't reduce their incentive to hold government bonds, because the incentive to hold government bonds is the margin on the rate of interest between holding a bank deposit and holding holding government bonds.
Well, but you know, one of the problems of high in debt countries is that they find very difficult. Oh, something is happening to my screen. I don't know.
You just need to think about that yourself. You don't have to.
Something had disappeared.
Someone is unmuted, probably. Or...
I muted him.
Okay.
Yeah.
Okay, so you can continue.
Yeah. So anyway, but perhaps this is not a major point. Perhaps I misunderstood you, but I thought that there is a problem whenever you imposing a tax on government bonds, that the incentive holding bonds, especially where the interest rate is so low, may be a problem in high debt countries. But
yeah, I mean, you're right, Christina, that there would be a problem if they, in particular now with the rate of interest being so extremely low, if you were in effect just cancelling government debt. You don't want to cancel government debt because actually most government bonds nowadays are held by pension funds and insurance companies.
Exactly,
I don't know about Italy, but certainly in England, and that brings you into a whole different kind of a sort of fiscal issue, because there may be perfectly sound reasons why you don't want to tax pension funds, but you can. I think the taxing of the wealthy is something that that needs to be that can be done, and if you're if wealth is rising with let's say holdings of government bonds, I think this was Kalecki's idea, then there is more possibility of getting income from taxing wealth.
Mm-hmm.
But you tax it as wealth. You tax wealth or net wealth even. At one point he argued about taxing net wealth.
Okay.
All right. So are there any other questions? Please raise your hand if you have one. From the chat, I think Dava wrote how far Kalecki's fable on debt management is relevant for managing interlocking chains of debt of household, corporates, and government in contemporary COVID-19 induced recession.
Yes, it is absolutely relevant, because we have if you look at the way in which money is circulating, it is becoming more and more highly concentrated. I mean, I don't know about countries other than the UK, but I've been following the data which the Bank of England publishes on bank deposits and on personal borrowing. The expansion of bank deposits is enormous, and with it a huge paying off of household debt in the form of credit card bills, which clearly is the result of the middle classes receiving incomes but not being able to spend. There's something similar happening in the corporate sector, even though large sections of it are heavily into debt. I think this is it's a very, very interesting research question, but it's an empirical one. In this respect, I'm very much with Minsky. You have to understand the debt structures which are being created.
All right. I see that Eckhart wrote in the chat box. Eckhart, do you want to? I don't know if Eckhart is still with us. Do you want to ask yourself a question or?
No, this was just a response to Amitava in the chat.
Okay. All right. All right. So, do we have some more questions? If not, I think we can end this session. So thank you very much, Jan Toporowski, for your interesting presentation and for all the participants or for all the questions that you asked. Okay, so I think we end the second day of the Kalecki conference. Louis-Philippe, do you want to say something?
I just wanted to thank everyone. Thank you, Jan, and thank you those who are sticking around for the full 2 days. I realize 6 hours a day, it's a lot, but I honestly been so interested in what's been presented that it doesn't feel like a full day of presentations, and that's certainly a testimony to the presenters. Thank you very much, everyone, and I'll see you tomorrow morning.
Yeah. Thank you very much.
Conference dinner?
Thank you.
Thank you. Bye.